How does operating income relate to the cost volume profit analysis? Well, let's begin by the cost volume profit analysis. Well, what this seeks to do is measure how any changes in cost or the volume of production affects the profitability of the organization or the project or process. Okay, now, so what is operating income? Well, it's revenue minus cost of goods sold, which gives you gross profits, minus your operating expenses, those expenses associated with this operational process. Okay, now, how does that relate to the cost volume profit analysis? Well, remember, the CVP analysis is generally used to determine at what point an organization or a process breaks even. That is where it's the money that it brings above cost is equal, okay, or is zero. Okay, so with that being said, how do you arrive at this calculation? Well, your break-even point is your total fixed cost divided by your contribution margin per unit. And contribution margin is simply your revenue, okay, from sales minus your variable costs. Okay, so if you subtract total revenue minus variable costs, then you divide that by the number of units produced. You have your contribution margin per unit. You divide your total fixed cost as part of the process by that process, and there you go. It will show you the number of units you need to produce to break even. Now, how does this again relate to operating income? Well, at the break-even point, that is when your operating income is equal to zero. Okay, now you can also use the cost volume profit analysis for other simulation or what-if analyses just to see what the changes in net income will be with regard to any changes again in total production or the cost integrated into that production process. And once again, at that point, operating income would no longer be zero. You would have an operating income that relates to, again, or has an output of that relates to the changes in cost and total of production. So once again, that break-even analysis, in this situation, the CVP analysis, would give you what your operating income is. So that's how the two, again, relate.